Well, we have been enjoying, or at least if you're along the market, enjoying a summer rally in stocks. Investors trying to figure out now what's next for the markets, what's next from the U.S. Federal Reserve. Could they actually be ready to pivot from their rate hiking cycle? Well, our featured guest today warns that we might be in a classic bear market rally. Joining us now, Michael Craig, head of asset allocation at TD Asset Management. Michael, great to have you here. I mean, this is the question of the summer for investors. Can we put faith in this rally? What are we seeing here?
Well, we're coming off really bombed out sentiment levels in late June. And I think you go into the summer, people are on vacation, liquidity is light. And, this is classic bear market dynamics where you get these, double-digit rallies off depressed lows. And so, the question is, have we put the lows in and is it sustainable? And I would say you look to next 2 months are typically very challenging seasonal periods. I would be quite cautious going into September at these levels after seeing such a big double-digit rally in the broad bourses.
Yeah, because of course the big story of the year has been inflation, and it kept moving higher and higher and higher and really sending shockwaves through the market. So we got the Canadian number today. We're starting to ease, but still uncomfortably high. We got the U.S. number recently, and the market rejoiced in the fact that, it's only 8.5% instead of 8.7%. And then these expectations think, well, then the Fed will just pivot off of all this. I mean, are these sort of lofty expectations? Are we getting a little ahead of ourselves if that's your market thesis?
Yeah, it's pretty, you're really looking at the market with rose-colored glasses. It's like losing weight. The first 5 pounds is easy. It's just water. And then the hard work begins. And the inflation numbers came off as a function of gas prices, some used cars. These are all very cyclical factors that, I don't think this should shock anybody. But, again, summer dynamics, not a lot of people in. You had some good news in the back of a bleak outlook. And so the market really ran with it. For us to take this then and say, well, the Fed's going to pivot is a bit of a stretch. We're probably going to be around on a 5 handle by Christmas on inflation. But the real challenging part is the structural aspects. And I do believe that will fall. It's just going to take longer, and that's really where it gets you into the owner's equivalent rent and some of those metrics, which tend to follow employment, and they will take a longer time to roll over than the more cyclical factors. And so we're still going to be talking about inflation well into next year. And I don't think the Fed can really pivot until they have the inflation on a 2 handle, which I think is going to take longer than many think.
Is part of the discussion, I guess, perhaps around the Federal Reserve table or the Bank of Canada, that central banks seem to have lost a little bit of the faith of the people, right? I mean, earlier this year, it's like, don't worry, inflation's transitory, we don't have to act too aggressively, and suddenly it seemed like inflation had caught them out. Do they have work to do still to sort of restore our confidence in their ability to keep inflation in check?
I think broad media still has them under the gun, but if you look at the market expectations of inflation, they have come quite a bit lower. So in terms of market participants, I think long-term inflation expectations are anchored, might be too strong a word, but are certainly not getting away from them. The Michigan data on 5-year expectations came out last week, and it continues to trend lower. Shorter, year out, higher. But I think people think long-term inflation expectations are starting to be re-anchored. And I think if the various Fed governors have all kind of come from all different walks of life in terms of doves, hawks. They've been uniform in terms of saying we're tightening policy until we get inflation under control. Very rarely do you see them all kind of singing from the same choir book, if you will. So that's where I think you have to take them at their word and believe that they're going to continue to tighten or have tight policy until inflation is well under control.
If we take them at their word then, and that they are going to do whatever they need to do to get inflation under control, could that mean a recession then? Could mean, obviously, the whole point of raising rates, right, is to start slowing, or it seemed like our insatiable demand when we were living off of cheap money for every asset we get our hands on.
Obviously, they don't want to create a recession, but if a recession is what it takes to get inflation under control, they'll take that. So, the other thing too, I think people need to understand is that we're going to see hikes hiked into the end of the year, but they're going to stay high for some time. The bond market's kind of looking for cuts as early as middle of next year. I'm not certain that's going to be in the cards, and so we're going to go through a period where money's going to be tight, it's going to be expensive, and that's what's going to, I think, hurt It's so much, we're going to get used to higher rates, and as they keep hiking. But it's that extended period of time with very, very restrictive policy. That's where I think you get into the recession situation, because the cost of money is so much higher than it has been in previous years.
Given all of that, what do we do as investors? I think it's pretty fair to say when you talk to the average investor, they feel burned by what happened in the first half of the year. They're a bit puzzled about what's happening right now, don't know whether they can trust it. What do we do with our money in times like these?
Well, first, it's the old adage. If you look at a longer-term chart, an index chart of returns, it's just a little bit of a blip. So we've got to put things in perspective. It's no fun being down 10%, but we've had it pretty good for a number of years now. So I always say, step back to what you're trying to solve for. The biggest risk for investors is getting to the day when you need the money and not having the money there. In terms of the next 12 months, a few things. One, the bond market's had a really rotten 6 months start to the year. Today, bond investors for a long time have been under pressure because yields haven't been very attractive. Today, I think you can look at the bond market and yields are far higher than they have been in the past, and that's something that we're looking at in terms of looking at bond yields in a 4 to 5% all-in yield on an investment grade index. So that's attractive. On the stock side, I would be cautious short term going into the fall. But at some point over the next 12 months, I think it'll be a very opportune levels for kind of longer term capital accumulation. And the third thing, what gets lost this year is that, last year everyone was an expert in investing. A lot of those fads have really been hurt this year. And so it's important to be mindful that we have these mark-to-markets, they're no fun. But it's that permanent loss of capital when you have things that just disappear. That's what really hurts investors. And so I would say, particularly going in the next 10 years, that's what you want to mostly avoid is permanent loss. And that gets you into kind of more tangential investments, if you will, and something to be watchful for as we come out of this and we start to recover.
Yeah, it sounds like if we still want to have that balanced portfolio in the longer run, it has proven to work for us. I think that faith being shaken, you talked how miserable it was in bonds in the first half of the year because people were looking and saying, okay, my equities are down, but luckily I'm diversified in my portfolio, whether it's 60-40 or whatever math you sliced up. Let's look at my bonds. And they're like, oh, and then their bonds as well. I mean, that was a bit of an anomaly, right? We were sort of going into unprecedented times where bonds were going to suffer to that degree at the same time that equities were suffering to that degree.
Yeah, I haven't actually been alive since the last time we had to start that terrible, and I'm not that young. So it is a bit of an anomaly. I think there is lessons to be learned. The first half of the year, outside of energy and commodities, would be the only really places to have hit out. And I do think we need to be mindful that in the next 10 years, stagflationary periods, something that we haven't seen for a long time, we did see in the first half of this year, are more likely than not to occur again. And so there are certainly areas where you can evolve the balanced portfolio. Our sense would be to use commodities, but and so there's room for improvement. But to abandon the strategy, I think, is unwise because you go through these periods, you have a tough, miserable time, but it does set you up for future higher returns as valuations are far more attractive today, even in equities than they were at the beginning of the year.